Good morning and welcome to the Saxo Bank Morning Call. It is Monday, June 17th, 2019, and I'm not sure I can recall an FOMC meeting that was more interesting than this one for quite some time. This is a really big week ahead. All asset classes looking at this FOMC for signals from the Fed, whether it is willing to fully engage with the degree of weakening expected, and interestingly, how is the market going to react? After all, if you look at the dollar, for example, we're expecting suddenly a lot of cutting from the Fed, and yet the dollar is towards the highs of the cycle. Let's look at the equity market as shown in the Nasdaq 100 here. You can see that 61.8% retracement. That's the obvious sort of area of consolidation here as we're waiting for signals from the Fed. Note that top horizontal line showing that we had that little false new high or rejected new high back earlier in the spring. Interesting setup here as we're either going to go for a run to the top and beyond, or maybe you're going to find resistance here based on this week's interest in the FOMC meeting. And now I think we should go to gold, because I think that was certainly the most interesting asset on Friday. We've had this tremendous run up and it sort of hit a brick wall at resistance.
It did indeed, and that obviously raised the question, or raising a few nerves now, because I think there's no doubt that we are seeing additional strategic longs being built into gold because of the expectation for further rate cuts. We have some geopolitical worries in the Middle East. But once again, if you look at the chart here, you can see how we just basically banged our head against the trend line resistance. This is the line going all the way back to 2014, and it came in at 1358 on Friday, and that's basically the high for the day. So the market is trading somewhat technical, and it basically has to do with the fact that we've been rejected so many times up here. So as we once again got up there, some profit taking started to emerge, and that led into some quite significant volume going through into the Friday. The reason why I write strategic longs versus tactical shorts is the fact that, as you can see on the right, we've seen quite a significant spike in speculative interest. Most of that has been bought above 1320, and that's just raising a few nerves, and that's leading really much over to you, John, because this is also expectation for aggressive cutting from the Fed. Can they live up to the expectations? If not, then obviously gold could potentially in the short term be in trouble, but strategically it's still being bought.
Yeah, it's interesting because it was that strong, I think maybe the strong U.S. retail sales, it struck a wrong note. You know, we had the weak payrolls cycle for May, and then we had a strong U.S. retail sales for the big upward revision for the April data, and that's not what the market's looking for gold, for Fed easing. Let's look at our probabilities. We got the Bloomberg famous world interest rate probability chart up here, or table, and you can see that the top line there, the June meeting, we're priced at around 17% for a cut, but note that the July meeting, we are priced for more than 80% odds that we cut by then. And if you look at the December meeting, you're looking at the big debate being 50-50, are we going to be 2 cuts or 3 cuts or more by December? So really interesting, and it really is all about, is the Fed going to deliver, and is the market going to be satisfied with that? I think one of the reasons,
and just to highlight that July number, 82%, a month ago it was 17.
Yeah, so exactly. We've had a tremendous...
It indicates this dramatic change we've seen in the shift, and again, turning to gold, that is the reason why we've seen this big spike. So again, if they can't...
Does the Fed send this aggressive rate cut signal as we're getting these record low unemployment levels, et cetera? One of the reasons, one of the key reasons I think the Fed could be looking to cut here sooner rather than later. We have a chart here from the St. Louis, this is the famous FRED database of economic indicators. They've got this trade-weighted U.S. dollar index. I don't know how they've calculated this, because a lot of other measures are not showing this degree of strength. But you can see where we are at basically at near the record since the 2000 spike. A strong dollar would be one reason. It was the reason back in early 2016, after all, that Yellen, the so-called Shanghai Accord, where Yellen announced this a much slower pace of Fed hiking rates back then to help ease that pressure. It was a strong dollar that clearly had the Fed fearing things. Of course, situation is different. I mean, that time around, the dollar had tremendous momentum after 2014 and 2015. This time around, it is high, but it's been sort of gyrating around in a fairly narrow range. Another measure, now go back to our chart, the Morgan CPI-based Broad effective dollar shows that yes, we're sort of elevated locally, but we're not even at that 2016 level, certainly not at the 2000 and 2001 area high. Let's recall back then, 2002, early 2002, I think the euro dollar was trading around 82 cents versus 112 now. So it's quite a different pricing there. Moving on in FX, let's just a brief look at cable. We're closed at the lowest daily close for the cycle, and weekly close obviously as well, around that 126 level on Friday. 125 is a major area. I'm not sure we're going to get any developments on Brexit. Most of this is dollar right now. We have the euro sterling fairly flat here, so we're awaiting this process. I put out a piece last week. Please look for it on home.saxo on why we could be constructive on sterling for the longer term, especially via euro sterling, and be looking to play that via options, even if we see a so-called hard Brexit, because we believe that the end game results potentially in a managed Brexit rather than this so-called no deal WTO terms hard Brexit that is sort of the thing that is put up as the most feared scenario. So keep that in mind. We'll be, of course, updating as things go along. And then lastly, I wanted to show this weekly chart, a key week for the Kiwi with the Q2 GDP coming out this week. The Q1 GDP coming out this week. Look at that weekly bar. These are weekly bars, so that last one engulfing and rejecting firmly the prior week's consolidation rally, and that sets us up for an interesting test, both over FOMC and within a couple of hours after that we have that GDP release from New Zealand. Now, Ola, the oil market has been all over the place lately. What's our latest take on what's going on here? We have this tanker situation. We've got all kinds of stuff going on.
Yeah, well, we are in a range, and we got some pretty opposing forces right now that could set it up for a pretty hot summer here. Take a look at the chart here. We found support in Brent crude just below 60. The upside level right now to look out for is around the 64.5 level. As I'm writing there, we got the slowing demand risk, which we saw was confirmed by OPEC, IEA, and EIA last week, all continuing to drop their demand growth forecast for this year. But against this, the geopolitical risks. Some are also arguing that the fact that we didn't spike last week when the initial attacks happened on these tankers and the US quite forcefully came out and pointed blame at Iran could indicate that if we see any slowdown in this reduction in this tension, then the downside risk is really quite evident, and that's the one that's really keeping the market here in this relatively tight range. The speculative interest, as I showed on the right hand side of the chart, basically show that there's been quite a big reduction in the net long. That's the yellow line over the past 4 weeks here, and that means as well the market is a bit more balanced than it was just a month or so ago. So really look out for the 51, 59.50, 64.50. It could be that we could see. I could see a $5 extension in either direction.
Yeah, so $60 really looks key as for a daily weekly closes, that $60 level on Brent. And you put out these great charts and weekly perspective on the U.S. futures positioning. Ola, you've brought your latest. It is Monday. They're released on Friday.
Yes.
So you've brought your latest round of data here.
Yeah, just it's a lot of numbers to go through, so I don't want to do that. Here you can read the update on analysis.saxo or home.saxo. But just a key takeaway from last week was this continued shift with the macroeconomic concerns hitting growth-dependent commodities like energy, but also copper, where the short is now at a record. And then the blue area, highlight area, is the weather concerns that's continuing to lift the grain markets, especially in the U.S. That has continued today. The weather is just simply not improving, so that's caused quite a dramatic spike in the speculative interest. The numbers, one I just want to highlight as well is the gold. You can see that additional 33% increase last week. That's now the highest in more than a year, the net long. And just to highlight, in the update, you will also find the explanation for what all these different numbers, what they mean. So you can take a look at when it's out on home.saxo within the next hour or so.
Great, good stuff. And let's look at our calendar for the week ahead today as well. The June Empire Manufacturing Survey, the first of these regional surveys, they didn't do a very good job last time around in showing or predicting that weak ISM, so I'm not sure the information value there at all. The NHAB is one of the best leading housing activity indicators in the U.S., so it could be interesting there as well. And then I didn't notice this one last week, but we have the ECB's Draghi. He's speaking at this Sintra. We recall this is a forum where he's made some pretty pointed comments on policy. So there's this idea that, of course, that the ECB is running without effectively any more tools in its toolbox. Could be interesting, though, to see anything he brings up at an ECB forum. There's got to be a sense of frustration from the ECB, no doubt, with its ability to move the needle. And then a couple Australian risks tonight. And then we have, of course, the FOMC decision on Wednesday. We'll be talking more about this. I can't emphasize enough, we need to be really on our toes with hedging, with exposure to the market. This could be a potentially I don't want to paint too drastic a picture, but I mean I think this could be a potentially cataclysmic move in the markets. Depending, especially if they don't send the dovish message that the market is looking for. I think volatility could spike very significantly. So, and I'm not sure I have a feel of the odds one way or the other, but the market is really key to react over this FOMC decision. We'll be talking more about that the next couple days, but just keep that in mind. I pointed out the New Zealand Q1 GDP release, and then we have potentially, I'm not sure how they roll out the actual announcement. It's been so long since we've seen this rollover in the leadership at the EU level, but supposedly this week they're looking at identifying the next EU Commission candidate. I think it sends important signals for the future of the EU around that. So keep that in mind, and then keep also in mind that on Saturday we'll have the final two candidates for this Tory party leadership vote. That's it for today, and stay on your toes. Be careful out there, especially this week again, and we'll see you tomorrow with Saxo Bank Morning Call. Thanks for joining.